Thank you all for being here. Thank you to Joji for getting today's conference teed up. A wonderful, wonderful turnout and a lot of great friends here in the room. As we get settled down, let me just share with you a few thoughts for today's conversation. I'm going to share two broad areas of conversation. One is something we just talked about, which is this concept of becoming a Southeast Asian company. Is it even possible? Is it even realistic to be pan-Southeast Asia? And if it is, how do you do it? A very important topic of conversation, particularly for entrepreneurs right now. And the second is around capital raising today. And as many members of the panel discussed a few moments ago, there is plenty of capital in the world. It's just not very evenly distributed. And in fact, here in Southeast Asia, there's a very interesting and persistent phenomenon that many of us call the Series B-C gap, or more evocatively, the Series B and C Valley of Death. But before we go into the serious stuff, I want to start something very fun. And some of you have seen me play this game before. Who in this room has heard of the concept of IQ, intelligence? Raise your hand if you've heard of IQ. Who's heard of EQ, emotional intelligence? Who's heard of AQ? No one. This is the ASEAN quotient. So now here's what I want you to do to play the game. When you see a city on the screen, and you're about to see the 25 biggest cities in Southeast Asia, when you see a city on the screen that you have been to, layovers don't count, you've been there, raise your hand. And keep track of how many times you raise your hand. All right, let's start. Who's been to Manila? All right, good. Keep track. Who's been to Jakarta? Good. Bangkok? Ho Chi Minh City? Who's been to KL? Brahmo? Raise your hand. Singapore? Who's not paying attention? Who's been to Yangon? All right, good. Hanoi? Bekasi. Now, keep in mind, Bekasi is larger than San Francisco. It's grown 96 times in the past 60 years. New York City has grown 1.3 times in the last 60 years. Who's been to Surabaya? Great. Who's been to Depok? Who's been to Bandung? Tangerang? Medan? Phnom Penh? Who's been to Samarang? Davao? Palembang? Who's been to Kanto? Well, good. Makassar? Batam? Who doesn't want to admit they've been to Batam? Mandalay? Mandalay's bigger than Raleigh. Chonburi? 43 times in 60 years, wow. Samut Prakan? Oh, nobody? One gentleman, good. Haiphong? Great. So who has been to at least 10 of the cities? Oh, I should mention there's a really nice bottle of champagne for whoever's been to the most. I'm told incentives drive metrics. Who's been to 15 cities? 16 cities. 17 cities. 18 cities. 19 cities. 20 cities. 21. 22. 21 cities. We have a new record. Congratulations. Could you pass this down to the gentleman over there with 21 cities he's been to in Southeast Asia? Sir, do you still work for MI6? No. I'm going to talk about two things today. The rise of Southeast Asian regional platforms and the ambitions that entrepreneurs have to build them, and what is still very much a very real thing, the Series B and C Valley of Death. Let me start with Southeast Asia. No surprise, particularly to the fine gentleman over there that's been to almost every major city in Southeast Asia. 9% of humanity, 3 trillion plus of GDP. But more interestingly, Southeast Asia isn't just unique in being big. Southeast Asia is unique in being relevant in the here and now. And when I talk to my LPs and my friends' LPs, what they often say is, okay, I get it, Southeast Asia, but why now? Why can't I just wait 10 years? And the reason some of you have seen me talk about before is something that we call the unicorn zone, a band of affluence between $3,500 and $7,000 per person per year, where discretionary income goes from 5% to 15%. So as you double your incomes on a log chart, you're actually 6xing discretionary spend. This is the zone where the big companies get made. And to validate this through a very simple objective backtest, Think about how China went through that zone a few years ago, Korea went through the zone, Japan went through the zone. In China's case, fully 2/3 of today's tech market cap went public in or around that zone. So the private equity transition to the public markets happened in that very special moment of time. Same thing happened for Korea, same thing happened eons ago for Japan, but you can still see the echo in the current market cap of companies that are leading companies in Japan today. And we are in that zone right now, and will be in that zone for the next 10 years. And in addition to that discretionary pool of spending, because of how large that is, it has encouraged people to be more ambitious than in the yesteryear generation. And it's very common for investors and for pundits to say, you know, be best of breed, focus on just one country. And indeed, that is exactly what happened in the first generation of tech in this region around the first dot-com bubble. But over the years, and we call it the second era, the jelly on the wall era, people tried different models. What is just so remarkable, though, is if you look, in the current era, the vast majority of companies are in the process of executing, the vast majority of companies that have succeeded are in the process of executing multi-country, multi-local strategies. It is a dramatic transition from era 2 and a very dramatic transition from era 1. How did this happen? Well, part of it is interesting. Part of it is it's a direct reaction, not just to the desire to build scale, but to the ingredients that we see here in Southeast Asia. The most salient part of this chart, which we call the chessboard of Southeast Asia, is the unevenness of it. So out of the 6 major countries that make up this wonderful region, 2 of them have big clusters of GDP. The rest in aggregate are interesting, but they're not as big. 4 have population. 2 have the programmers. Only 1, to be very objective, has the kind of financial firepower in terms of rule of law, arbitration, legal precedent, historical access to capital. And historically, 2 of the 6 countries, not unsurprisingly, the converse of this column, the smaller countries, have had that kind of hustle factor to be able to actually spread their wings, whether it's Air Asia or DBS or CIMB, or now today's generation of Grabs and Seas and Lazadas. And as a result, what we have seen happen are 2 different strategies for success in this part of the world. Strategy number 1 is you focus on Indonesia. In fact, if you look at the list of unicorns in Southeast Asia, I'll show you the list in a moment, about 2 out of the biggest 7 are pure play, by and large, Indonesia players. And a third, Gojek, has recently gone international, but began as an Indonesian player. The other strategy is to go down the column. So we call this the rooks on the chessboard. You go left or right, or up or down. And interestingly, the way you do number 1 feels a lot like the way you build a company in China or India. You have a development center, you have a go-to-market strategy. The way you do number 2, though, is very complicated, but compelling if executed well. Witness the size of C, of Grab, of Lazada, and many, many others. And I want to borrow into how you actually do number 2, because tactically it's very important. What you have to do, jump over this, is you actually end up having to stitch the region together. And if this looks complicated, well, it is. It costs a lot. Your SG&A costs will probably be 250 basis points higher than they would have been relative to revenue if you didn't have to pick multiple countries. But as a practical matter, a strategy 2 execution plan sort of looks like this, where you base your company, in most cases here in Singapore. Your CFO is here, your CEO is based here, your CTO is based here. You have a very strong cadre, often of folks that have the cultural heritage of the Malaysian Peninsula and Singapore, to go spread their wings across the region. But 80% of your employees are in market, deeply localizing what you do to be authentic and relevant. And this is exactly how we built C. And it's exactly how my friend Anthony has built Grab, and it's how Max and his team built Lazada. You have to figure out a way to have the best of both worlds, to capture the jurisdictional sensibility of Singapore, but to be authentically local with 80% of your workforce in each market. And interestingly enough, the first generation of companies to do this struggled mightily. It was not easy. There was no playbook other than looking up to what Tony had done at AirAsia, what Piyush had done at DBS Bank. And interestingly enough, of the 7 sort of largest unicorns in this region, 5 of them went regional, and 2 of them have remained somewhat more Indonesia focused. And interestingly, and again, it's not meant to be a value judgment, it's simply a statement of fact, the ones that went regional tended to have a more global background. They tended often to have studied in the US for business school or undergraduate, and they often happened to have gone to McKinsey for a bit of further business education. And that gave them a connectivity across the region, because in our mind as entrepreneurs and investors, to build a startup, one of the most important unappreciated ingredients is cohesion. And typical cohesion comes from really only 3 sources. One is there's ethnic cohesion. So you see the Finns running around the world at Nokia. You see ethnic cohesion even in the case of American companies like GE, to a certain extent very American-centric. Many Chinese companies go abroad with a very local national strategy. The second cohesion, which this slide represents, is university cohesion, or sort of first employer cohesion, where you meet a bunch of people who were Indonesians and Thais and Vietnamese and Singaporeans, and they're pulled together into a team. C, for example, is really the product of the Singapore Scholars Program and Stanford University in terms of how we all met each other to be multi-ethnic and multi-regional. But there is a third source of cohesion, which I think is dramatically simplifying the process of building pan-regional platforms now along a Category 2 strategy, and that's what we would call the oak trees and the acorns. There are now about a dozen very large platform companies that have gone through a very significant period of growth, some successful, some less so, but all having produced an alumni base. And each of these countries, for better or for worse, has tried to be multi-country. So the next generation of startups we see oftentimes derive ancestry from one of these roughly dozen academy companies that taught them business, taught them growth hacking, maybe most importantly, introduced them to their other co-founders from multiple countries who they would never have met ordinarily, who will now start a company together. And by the numbers, these 12 companies, give or take, have produced 20,000 alums who are still sitting here in Southeast Asia, who in turn have created approximately 2,000 companies, some small, but I can guarantee you the next generation of unicorns will draw very heavily from this listed companies over here. So first thought to share with you, the entrepreneurs have a very deep ambition to be regional. There will always be single country specialists in all the different countries, but again, to reiterate, I think on balance, most of the unicorns that we think will come out of this region will either be Category 1s or they'll be Category 2s. And the venture capitalists that are a little bit upstream of my business and certainly sort of helped to create this industry, this market, they get the joke. 70% of all the upstream financing for startups in this region at that $1 million to $20 million check is indeed Singapore jurisdiction or Indonesia jurisdiction companies, very much following a strategy 1 or strategy 2. The interesting question is, what do you do with these companies now that literally there are 2,000 startups in the market that aren't just alumni of leading universities or all came from one country, but are actually alumni of the first generation of unicorns? How do you finance their growth? And we spoke about this chart a few moments ago, this sort of progression from the seed stage to the later stages of capital. What is so interesting and I think very odd about our particular market is that there's a massive gap here. I would argue that there's a wonderful level of firms in this market. We count these things pretty rigorously, and almost every month there's a new GP over here. The most recent one was Bini Bansal's family office that just announced. Lee Fixel is in the market as well. People are entering this segment very, very consistently. About 25 or 26 GPs over here, several hundred families over here. And in this market, as you just saw on the stage a few moments ago, a very wide group of firms all looking to do deals above the psychological threshold of $100 million, which, for better or for worse, does move the needle on a global basis. When Property Guru had their data room up, ultimately became a $150-ish million round, there were at least 24 firms looking at the data room from what we understand in the very early stages. But here, there's a real shortage of capital. I want to really accentuate that point because there shouldn't be a shortage of capital in this part of the market, in part because there's a lot of upstream companies to look at. In fact, on average, every year now, given the 25 or 26 GPs in that 1 million to 20 million segment, there's about 120 deals being done per year. Historically, it sort of ramped up to that point, but there's still 310 deals to look at over just the last 4 or 5 years alone. So it is surprising in terms of the upstream supply, but if you look at it by the numbers, it's kind of one of those funny bits of arbitrage that will take some time to kink its way out of the system, but it exists. In America, in that blue zone between $20 million and $100 million check size in tech, not including bio, not including non-tech, there's about 2.3 deals that get done annually per million citizens of the country. In China, it's 0.1 deals done per million citizens of the country, but of course an awfully big country. In Southeast Asia, it's 0.02 deals that get done at the growth equity stage. Again, not for lack of upstream supply. It's more for lack of capital supply in this market. And you can actually quantify how big the gap actually is in the market. And you can trace it and see how it might be different than other markets. What I'm about to show you is a little geeky, but it's actually a very crisp way to see visually that Series B and Series C gap. Take a look at this. The gray line is China. The blue line is Southeast Asia. What we've done very meticulously is taken AVCJ data deal by deal by deal for the last 4 or 5 years And we've plotted them from the biggest deal done in the private markets in tech to the very smallest deal. So the biggest deal, I think, was the Alipay and Financial deal a few years back, big chunky one, around $10 billion. The smallest ones, of course, fall off the scale. And we've shown it to you, again, kind of the small checks up to $20 million, 20 to 100, 100 plus, and so on and so forth. And then we've just shown them on a percentile curve from the very biggest deal, again, percentile terms, the smallest. Simple way to look at it, when the curves overlap, the two ecosystems are pretty similar, adjusted for population and GDP size. They're normalized against the same curve. What you see here is that exactly at the $100 million point of deal size, the curves peel apart. And this may not seem like a lot, but on a log scale, it's a big deal. This is visually the Series B and C gap. And in the last few years, really the last 24 months, this has started getting filled in, but this is wide open. In fact, you can quantify how big it is. In Southeast Asia, every year, last few years, we've put about 2 basis points of GDP into deals in that zone, so in dollar terms, relative to our affluence. China puts in about 5.4 bips of GDP. Let's not even bother comparing ourselves to America. That's a generation in the future. But relative to China, if we simply index and said, well, shucks, against our GDP, admittedly smaller than China, if we were to be putting about 5.5 bips of GDP into those growth-sized companies, what would be the incremental amount of capital that would represent? It's about $1 billion a year. So there's basically, if you go back to this thing, this aperture, this bit of daylight between the gray and the blue, that represents $1 billion of missing capital every year in that $20 million to $100 million check size range. That's the bad news. I'll give you the good news, and maybe leave on maybe a more optimistic note. There's actually precedent for doing this, fixing this gap, which actually comes to us again from China. Take a look at this. This is the journey of China from the very earliest stages of technology investment in the country, private markets, to the present day. And instead of showing it to you on a time axis, we did something a little cute. We showed to you on an affluence axis, inflation-adjusted affluence per person, 1,000, 2,000, 3,000, all the way up to the present day. This will allow us to overlay Southeast Asia in just a second. And what you see is the very first fund that exists in kind of the fossil record, the very first trilobite in the fossil record, is a 1993 fund that was able to write kind of roughly $10 million checks per deal, plus or minus or so. And then for a good dozen years, it was the land of small check sizes, and there was a real gap over here. Starting in 2005, the first growth equity tech funds emerged. Only one of them was actually one of these original funds that upgraded. They were a distinct species of sort of animal in the market. And for another kind of 10 or so years, they had their era where they were the largest capital providers. And then more recently, starting in 2013, and it seems like so long ago, but really fairly recently, you now saw funds that had the firepower in terms of their committed capital to write $100 million checks and above. Now, interestingly, we're following exactly the same journey. So now if you just overlay Southeast Asia, again, we're about 11 years behind China in terms of affluence. All the blue dots are us. All the gray dots are just as a reference base China. The dots will never perfectly overlap. It's a bit idiosyncratic. But in general, broad brush terms, we are following exactly the same journey that China has been following, in that we're ready now to have slightly larger checks in the ecosystem, and really to position companies, I think, either to go regional or to go deep in Indonesia, but most importantly, to really fulfill their true potential to become large in a way that we've never really seen in this region before. So I leave you with a note of optimism, which I think is, at some point, 5 years from now, if I come back to share some perspective with you, I think you'll see a hell of a lot more blue dots here, as well as a hell of a lot more blue dots here. And perhaps 10 years from now, you'll see the very first chunky tech funds for Southeast Asia. But where we are, if this were the shopping mall map, you are here, we are here right now. And I think what you'll see in the next 5-6 years is a solution to the Series BC gap. But for the near term, I think a pretty compelling arbitrage opportunity to put capital to work in those segments because there's just so little of it. Pause there, maybe you can answer 1 or 2 questions, and then I can relinquish the time to the rest of the agenda. Any questions, comments? All right, well good, thank you very much for the time. I hope you enjoyed the bottle of wine, sir. And have a great day, everybody. Thank you.